Sasfin Securities. Elevated oil market risk. The two benchmark crude oil prices, Brent and West Texas Intermediate (WTI), have been rising in the last 3 months. The crude oil market prices reached their highs for the year in June on heightened risk associated with the growing civil war instigated by Sunni insurgents and fragmentation of Iraq, together with continued supply outages in Libya. In addition, there was an apparent building of China's strategic oil reserve in April and May, which strengthened demand. Global crude oil demand forecasts tend to be more accurate than those of supply. The International Energy Agency, IEA, forecasts global oil demand to rise 1.3 million barrels per day, MBPD, in 2014 to 92.8 MBPD. This is a moderate increase in line with the slow acceleration in global economic activity expected in 2014. Much of the crude produced in the world is from regions that have recently seen significant levels of political unrest, particularly countries in the Middle East. The Arab Spring uprising in Libya and Egypt has directly resulted in loss of production. Production infrastructures were impacted by the loss of key operations personnel who fled the countries and also by producing fields that were shut down. In Libya, crude output fell more than 84%. In Iran, the second largest producer in the OPEC cartel with potential production of 3.0 MBPD, economic sanctions brought to bear by the international community due to the country's suspected nuclear weapons development program have impacted the country's ability to export crude and import spare parts needed to maintain production facilities. Unless the spreading and intensifying conflict in the Middle East abates, the security risk in global oil markets could increase with a direct effect on the risk premium in the Brent oil price. There will be growing dependence on the main conventional oil producers in the Middle East as non-OPEC production starts to decline, especially in the North Sea fields in the second half of this decade. The U.S. economy is recovering. Q1 2014 was negative for abnormal weather reasons. Employment growth is firm, consumer confidence is rising, and consumer spending, the backbone of the U.S. economy, is expanding at a moderate pace. Monetary policy remains highly accommodative, which is supporting durable goods consumer spending. The IMF's 2.8% US GDP forecast now looks to be too high, given the negative growth in the first quarter. US 2014 real GDP growth is likely to be somewhere between 1.7% and 2%. While there is evidence of a strengthening industrial sector and great advances are being made with shale oil technology in reducing the US's dependence on imported oil, negative growth in real median household income remains a concern. The heavily skewed income growth dictates that the lower and middle-income households continue to struggle financially and are minor participants in the current recovery, which poses questions about the sustainability of the current U.S. consumer spending growth path. Secondly, business investment remains unusually muted and is an essential factor in sustained employment expansion. Slowing household income growth. The retail sector has come under increasing strain this year, due in part to slowing household income growth, slower household credit growth, and rising inflation, affecting particularly the lower income groups. Household consumption expenditure in South Africa exceeds total available household resources, which consist of gross household disposable income plus the change in pension fund reserves plus a residual. Formal employment rose 1% in 2013, comprising 1.63% growth in formal public sector employment and 0.09% growth in private sector formal employment. The average gross earnings per employee is highest in the utilities sector, followed at a much lower rate by the transport, logistics, communications cluster, and then government services. A new factor which has emerged in 2014 is the prolonged strike action. In most instances, there are no work, no pay policies related to strike action. This has had a serious impact on private sector formal employment compensation growth. The length of the strike dictates the severity of the income loss. The lower income groups are worst affected by these strikes. South African households have been dissaving since 2005. and therefore have limited resources to sustain household spending rates if income is lost or its growth slows. This means that credit is the compensating factor. The key limiting factor is the level of household debt to disposable income, which has ranged between 82.7% and 75.1% since 2005 and has recently got stuck around 76%. The household debt levels continue to rise. The much-discussed wide income gap dictates that the mix of income and therefore debt is highly skewed in South Africa. While headline trends are indicative, investors need to understand the income and debt mix in order to prudently assess the quality of the growth in household consumption and credit markets. In the absence of protracted key industry strikes, real household income growth is likely to stabilize at a real rate of 1.5% in the next year. Strike disruptions are affecting low-income group remuneration growth. The high household debt to disposable income level in South Africa dictates that there is little household balance sheet capacity to take on significantly more debt to sustain household consumption expenditure growth. The high-income group in South Africa appears to be relatively insulated from strike-related income losses and much of the increase in non-discretionary expenses. Households are credit constrained. With household disposable income growth slowing due primarily to slower real employee compensation growth and more recently income loss through prolonged strike action on the main platinum mines, the need for credit becomes more important to sustain household consumption expenditure growth, especially in the lower income segment of the market. The mix in the credit granted is changing in favor of asset-backed credit and away from unsecured credit, credit facilities like credit cards and bank overdrafts, and short-term credit, transactions less than 8,000 Rand for no longer than 6 months. In September 2013, the Cabinet approved the removal of adverse credit information, disregarding industry objections. The decision was to have the adverse credit information of consumers who have paid all their debts wiped clean both as a once-off event and on a continuing basis. The aim is to eliminate the blacklisting of about 1.6 million consumers, many of them public servants who have paid their debts but are still prevented by listings by credit bureaus from gaining access to credit, accommodation, and even jobs. The idea behind the scheme would be to secure the re-entry of these consumers into the credit market and hopefully boost consumer demand. This scheme has not changed the credit providers from tightening their lending criteria and has not resulted in a noticeable boost to consumer spending. The national credit picture shows consumer credit growth continues to slow. The main slowdown is occurring in the lower income segments of the market, which accesses unsecured credit. Accordingly, there is a shift in the credit mix back towards secured and away from unsecured credit. Mortgages show the strongest gain in quarterly credit granted in Q1 2014, but even in this segment, there is a marked divergence in growth rates, with strong positive growth in the high-income area and sharp negative growth in the low-income segment. There is strong negative growth in the quarterly unsecured credit granted, and of concern is the deteriorating age analysis in this segment of the market. The income disruptions caused by the strikes, low employment growth, and tightening credit standards, especially in the unsecured lending market, offer little respite for these consumers. Of the credit providers, the banks are enduring slowing consumer credit growth, but the quality of the high-income segments of the consumer credit market are improving. Difficult trading conditions persist for unsecured credit providers. There is a shift in credit market share away from credit retailers towards the banks. Stocks that we are interested in. Google. Google is a global technology company. Its mission is to organize the world's information and make it universally accessible and useful. In 2013, its sites were the most visited internet properties led by visits to its core search engine. It also leads the development of the Android mobile operating system and owns YouTube. In 2013, approximately 80% of revenue was from advertising. Google is currently the world's dominant player in online advertising and is expected to maintain this position in the foreseeable future. The near-term upside is anticipated from improvements in cost-per-click trends, greater contributions from its investments in video, tech hardware, operating systems, enterprise applications and computing, and Google Play. Google recently unveiled a set of ad format and targeting enhancements to its mobile app advertising offerings across search, display, and YouTube. Google will also enable advertisers to leverage its mobile app deep linking capabilities to drive users to content or functionality in already installed apps. This is important because time spent in mobile apps is 6 times the time spent on mobile web and can therefore meaningfully improve the efficacy of Google's mobile advertising efforts. Google remains at the forefront of internet innovation and in monetization of that innovation. This speaks to management quality. The company provides exposure to the secular growth trends in internet. In the longer term, a key part of the investment case is the company finding a balance between innovation and shareholder expectations. In this regard, achieving flattish margins with mid-teen revenue growth and providing cash returns to shareholders are likely to satisfy the market. The investment case for Google is based on its reasonable valuation, leading position on internet secular themes, and the quality of the management. It focuses on innovation and disruption, thus attacking mature business models in a number of sectors. AIG. American International Group Inc. operates as an insurance company worldwide with more than 88 million customers in 130 countries. The company provides a range of property casualty insurance, life insurance, retirement products, mortgage insurance, and other financial services. AIG companies employ over 64,000 people in 90 countries. AIG insures 50% of the top art collections in the US and 40% of Forbes' 400 richest Americans. During the crisis and restructuring, AIG retained 90% of their clients. AIG is improving and integrating their fragmented systems. Before the financial crisis, AIG insured tens of billions of dollars of derivatives against default, but did not purchase reinsurance to hedge that risk. Secondly, it used collateral on deposit to buy mortgage-backed securities. When losses hit the mortgage market in 2007-2008, AIG had to pay out insurance claims and also replace the losses in its collateral accounts. AIG is completely different from the AIG of old. Currently, AIG is more of a vanilla insurer than the high-risk company before the crisis. They also repaid the bailouts received by government. Our investment case is based on an improvement in ROE, which will be achieved through a combination of share buybacks and profitable growth. The stock continues to screen as cheap on both an earnings and book value basis. The company has been getting rid of non-core assets, and as a multi-line with more than half its earnings and a third of its capital employed in life insurance, it will benefit from rising US interest rates and improving equity markets.